Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get in today's Q&A session, and the first one is from Jim, which is the pseudonym, but that's probably not that important, right? Anyway, Jim writes, we are in our mid-40s and have a primary place of residence worth 1.15 million in the outer suburbs of Perth and two investment properties. One is valued also at 1.15 and fully paid off in the wife's name, earning $1,000 a week in rent. The other is worth 1.6 with 1.44 million in the husband's name, renting for $1,300 a week. Husband is in the top tax bracket, earning $600,000 a year. Wife's earns around $50,000. So as I understand it, no home loan debt. We've got a property that has no loan against it in the wife's name, which is kind of good because she's a lower income earner. And then a property with mostly geared in the husband's name, giving them negative gearing tax benefits. Anyway, Jim goes on. We want to move more centrally and unfortunately into a more expensive suburb in about 5 years as the kids will be older and going to uni. We are overall cash flow positive on the investment properties by about $10,000 and also have surplus investable cash of about $100,000 a year. We're not sure whether we should do one of three options. Firstly, buy a $2 million property now in a more expensive suburb, negatively geared that property, and then move into that property. Number two, invest the spare cash into ETFs and then sell to help pay for the upgrade. Or number three, buy a high yielding property in a trust account and just keep growing our investment portfolio, then take a bigger loan when we need to move. Any advice would be of great help. Thanks, Jim. So to answer this question, I should say, you need context, right? Because, for example, going and investing or buying another property or investing surplus cash flow over the next 3 years, what impact will that have on Jim's situation, Jim and his wife's situation, in terms of giving rise to higher non-tax deductible loan in the future when they eventually do that upgrade, and then the amount of cash flow that higher non-tax deductible loan will suck out of their situation in terms of being able to service it and repay it. And there's an opportunity cost associated with that, right? So if we're going to spend the next 10 years repaying this large home loan, well, what about super? What about other investments? Is that a priority? Do we need to make additional capital contributions? Or in fact, if we've already got those investments and assets worked out, then it could be completely fine. So that's why it's difficult to answer these questions. That's why a long-term strategy gives us context for making these decisions. For example, if we don't find a way to reduce the amount of debt that we take on to implement this upgrade, we're potentially putting future retirement at risk. I'm not saying that's going to be the case in Jim's situation, but we really need to work out, is it? So firstly, I don't know the answer to that question because I haven't built a long-term financial strategy or done financial modeling for Jim, but just typically and mathematically, almost always, it makes sense to limit the after-tax cost of upgrading a family home. And the reason for that is because, if I can spend $2 million today or $3 million in 5 years' time just because of the growth of the asset and how much it costs me to get into that market, that's an extra $1 million I need to find on an after-tax basis. So really, I might need to earn $2 million to pay, if I'm just saying 50% tax, to repay that extra $1 million cost. So $2 million of income is ripped out and going towards just paying the delayed factor of upgrading the family home. And that can be that, obviously that's a sizable cost, it's a sizable amount. And so typically for that reason, I like to try and get that family home, that upgraded forever family home, as soon as I possibly can. And a really tax effective way to do that is to buy it and then gear it. So option one, if I was in your situation, that's what I would be exploring, Jim. Sounds like you've got the cash flow in order to do that. You've probably almost certainly got the borrowing capacity to do that. And what you would do is buy the parcel of land that you want to occupy. So it wouldn't be, and the structure that is structurally sound, but cosmetically you might want to make some changes in the future. So to execute this strategy, it's not about buying the perfect home now. It's about buying the block of land where you want to be. So in that location, great street, quiet street, in the exact location that you want. With the bones, in terms of the dwelling on that land, the bones need to be sound. So structurally sound doesn't necessarily need to be move-in ready, because obviously construction costs change, but I think they'll level out in terms of the cost to construct and renovate. So in 5 years' time, it will probably cost you more, but it won't cost you significantly more, not to the extent that the underlying land value will probably increase. And also, you don't necessarily want to buy a brand new property, for example, something that's just been completely renovated and necessarily put tenants in it either, and then occupy that property in 5 years' time. That might not be the best approach. Might increase the yield, but it might not be the best approach. So I would just buy great asset, something that's tenantable, and then in 5 years' time, if you've got to do a full reno to it, no big deal, but at least you've locked in the asset at the time you're going to be unnegatively gear it between now over the next sort of 5 years. So that'll sort of just defray some of the holding costs. And then when you make that move, you'd sell your current primary place of residence, because obviously you can do that without paying any capital gains tax. And, you might even, depending on your position and situation, you might even sell the property in your wife's name that's not geared, because there's a large opportunity cost to having a heavily geared home loan and ungeared investment property. Now, of course, you've got to pay capital gains tax to exit. So you just want to, and you've got to think about where it is in the market. But I can't help thinking in 5 years' time, it might be not a bad idea to kind of exit that investment anyway. And then you'll be left with hopefully very little debt on your family home and one investment property. And then hopefully you've got super as well. And together with all those things, hopefully you're off to the races in terms of funding retirement. Now, if you put your spare cash flow into ETFs over the next 5 years, it could work out well, but it's not a long enough time horizon. In order to make those investments just for 5 years and sell. Could work out, but not a long enough time horizon. And third, buying a high yielding property in a trust. Well, I hope, most people have learnt, at least from my philosophy around property, it's a growth asset. So, you've got to think about the overall return of a particular property. It's probably unreasonable to expect that overall return, so net rental yield, so rental yield after expenses plus growth, to exceed 10%. And we know that, the power of compounding is the sort of easiest way, takes time, but easiest way to build wealth. So buying a property in a trust, firstly, not great for land tax in most states. So you don't own it personally. Buying a property, a high yielding property, just means we're probably going to forego capital growth. So I don't like that either. I don't like that in any situation, even in Jim's situation. But thanks for your question, Jim. And you did give some great feedback on the podcast. So thank you also for that. And good luck with your decision making. Okay, next question is from Kayt. First of all, love your podcast. I've been binge listening since I found it. I found it hugely beneficial in expanding my knowledge and preparing for retirement. You're most welcome, Kayt. I have one suggestion for something to discuss in an episode and one question. Firstly, this is a suggestion. A lot of Australians are employed by the government sector and tied to various government superannuation funds without the option to choose their own fund. Leaving out defined benefit funds, could you do a comparison of these schemes so that government employees can assess options, reinvestments, and extra super, or investing outside of super? It's a really good suggestion. And actually, I've been thinking very deeply about the super episode that I prepare each year when I'm looking at returns. And, as I said in this year's episode, retail funds, and I'll come back to government funds, but retail funds are actually a lot more competitive today, both in terms of fees and returns, than they were 10 years ago. So, 10 years ago, even 5 years ago, it was probably okay just to focus on the industry super funds. But really what I should be doing is casting a wider net and having a look at different options within the retail funds as well. There's some low cost options out there as well. And then the government super funds, that's really interesting too. I haven't looked at them more recently, but I remember looking at them within the last 5 years, but it was probably a few years ago now, and being so surprised that returns are quite poor. And isn't it funny how the government always does this? They'll throw stones at industry super funds or retail funds for not picking up their game, but when they run their own super funds, they're not following their own advice. It's much like with public housing. States will have a go at private landlords like me and our listeners, but in terms of the maintenance and looking after the tenants in public housing, they're doing an absolutely poor job in regards to that. So it's funny, it's sort of the government will, we'll do what we do what I say, but not as I do kind of mentality. mentality. Anyway, thanks for the feedback, Kayt. I think the answer is I need to produce a much more comprehensive analysis and comparison of super funds. And I'm giving that some thought. And, what I want to do actually, I've been thinking about it more recently, is investing a little bit more time maybe to produce, a handful of different episodes that have a heavy undertone of research or backed by a lot of research. And super could be one of those things. I think there can be some benefit in expanding that net a little bit wider than what I've been doing. So I'll put on the to-do list and let's see how we go, Kayt. Thanks so much. Okay, now to Kayt's question. I'm 57-year-old female, I have a residential property worth $700,000 and then $1.4 million in Super SA, which is obviously a public fund. It's an untaxed fund, which means contributions aren't taxed when they are contributed, they'll tax when they come out. So there's not many funds like that around anymore. So she estimates the tax liability will be about 100,000. So instead of 1.4, it's 1.3, still pretty sizable. Kayt's wife is 58, has about 600,000 in Australian Retirement Trust, the ex-Q Super Fund, which was previously called Q Super. Okay, due to health issues, we're both retired and we're living off funds from the sale of a business until we can access super, which is obviously 2 to 3 years away. There's no expectations of further super contributions. My question after listening to your show is, what advantage will there be using a financial advisor to manage our funds over simply putting them into a Vanguard income stream product? I'm really nervous about all the stories about fraudsters and scammers and financial advisors going bust, and I feel Vanguard offers a simple answer to those concerns. My mother has used a financial advisor who seems very honest, and she's allowed me to view her financial reports. I must say I was a little concerned to see that he was taking $14,000 annually in fees. Her accounts are worth about $1 million. She is drawing about $70,000 a year from her 2 wrap accounts. She's a widow, so one would be probably the husband that's passed away. Anyway, that percentage seems excessive, but I don't know if that's normal. Excellent question, Kayt. And of course, as a financial advisor and someone runs the financial services business, you've got to take my view based on that. There's a potential conflict. So I recognize I put it out there. But, so the view that I take when answering these questions, well, every question, and producing episodes is, what would I tell people if I knew everything I knew today, but I wasn't in the business, in the financial services business, and my income wasn't linked to that? And what would I tell that person to do if that person was my brother, sister, parent, and so forth? And I've always sort of taken that approach to take my hat off. There's no conflict now, but I still know everything I know, and I really care deeply about the person I'm giving advice to. And that's always the approach I take and the people in my business take. And really any great quality advisor will do exactly the same thing. This is not unique to me, of course. But I just want to acknowledge, of course, I've got a conflict of interest there. The way I'd answer the question is that Kayt's got 1.3 mil of super and her wife's got 600. So about 1.9 million, which is pretty close to the 2.2 that I say that you can. I did this episode a while ago about, how much money do you need? And, that sort of 2.2 gives you a perpetual portfolio of being able to spend $120,000 a year for the rest of your life, pretty much. So they're pretty close to that mark. And that analysis would have been done using 7%, which is what I use, because you've got to deal with sequence of return risk. So I tend to use a pretty conservative number in terms of returns. So I guess what I'm saying is that fees and performance is relatively important to Kayt and Kayt's situation. If the super does well, they'll never run out of money and they'll have a lot of financial security for the rest of their life. If it doesn't do so well, then maybe that won't be true. Now, Vanguard is a great business, but Vanguard is all, in particular their super fund, is all market cap indexing. So that means that a large proportion of your balance will be invested in Nvidia, for example, in the US, which is the company that has the highest concentration in the S&P 500 in history. So it now represents about 8.2% of the S&P 500 index. And you'd have to go back to, Apple in about sort of 24 was 7.6. You can go back to the 80s when IBM was 6.4%. You've got huge concentration risk there, which I've spoken about before. And so that would be a concern that if I'm going to put all my super in market cap indexing, and then, someone invents a better chip. I realize NVIDIA is sort of at this stage well ahead of the market, but you wake up tomorrow and some unicorn has invented a better, faster chip, cheaper chip, and all of a sudden NVIDIA will be worthless tomorrow. I mean, that's far-fetched, but you know what I'm sort of saying. So that's my concern with market cap indexing. Look, is it worth paying for financial advisor? Well, I guess there's some elements here, right? There's the elements of practical value that they could add. And I think the practical value, because there's two things in a portfolio, risk and return. I think the practical value, and certainly that I see that we deliver to our clients, is not only do we reduce a portfolio's risk, but we do it without necessarily taking a haircut in return. And I think arguably positioning the portfolio to outperform the index, the market cap index, in the longer run by using different rules-based approaches. So I think there's a fundamental practical element there that you can point to. And then the other thing is an emotional value in terms of just feeling more in control, more secure, more transparency, something to ask questions and allay some of your concerns, and then also to stop you making mistakes. So there's those sorts of things. So then I guess it comes down to what does that value look like? Because the emotional part of it in terms of control and safety and comfort to some people means a lot, and to other people it's nothing. So, and that's going to differ from person to person. But you nearly got $2 million. I think it's actually worth having that well invested. And I'm not suggesting you can't do that using Q Super or ART, I should say, Australian Retirement Trust, and maybe another super fund. But I think a financial advisor is an easy solution there, albeit it comes with a cost. $14,000 to manage $1 million worth of money, so which is what Kayt's mum is paying, is insane. Okay? It's insane. It's double the fee that would be even reasonable to pay at the high end. And it really upsets me. Now, it's difficult, right, for me to sit here. Well, it's not really. I mean, it's easy for me to say the fee is insane, but I guess I don't know the full knowledge, okay? So I don't know if that fee included a component, was some one-off advice on a particular matter, or there's something unique to that person's situation, those sorts of things. But let's just assume it's just general portfolio management. That's insane. The old rule of thumb used to be you pay 1% up to $2 million and then the percentage fee would reduce. Now, I don't recommend anyone pay a percentage fee, but just to give people a sense, right? So 1% of a million is $10,000, but you don't need to pay that today. I would say the fees for market has sort of come back. So I think for $1 million to run $1 million, you would typically pay, well, I think it'd be reasonable to pay anywhere from $4,000 to $8,000. Now, I'm not saying people should be prepared to pay up to $8,000, but I'd say most of the market, that's what most of the market would be charging. And we actually just did an exercise with a consultant recently to sort of understand this in terms of where fees are sitting within the industry. So I feel quite confident with the figures that I'm quoting there. But also it's not linear as well. You've got to recognize. So to look after $1 million portfolio versus a $2 million portfolio, which is Kayt's situation, it's not twice the amount of work, of course. It's more work, but not twice the amount of work. So whilst you might pay, let's say, $6,000 to look after $1 million, you might pay $8,000 to look after $2 million. And so therein lies the scale. I mean, I say someone with $1 million, it's kind of line ball whether you'd pay for advice. But a family like Kayt's situation, getting closer to $2 million, I think given the market conditions and the concentration risk in the traditional market cap indexing at the moment, I think there's a higher basis for or rationale for getting financial advice, particularly if you have north of $2 million. And I think that fee to, run $2 million or look after $2 million worth of assets should be somewhere between 5 and 10,000, which is a broad range, I know, but that's what generally the market would look at. But I think it's wonderful. I'm really appreciative of Kayt asking the question, because let's get it all out in the open so all the listeners will have a better sense of what's right, where the value is, and what I need to really think about. And, the thing I should say is the best thing, and I've said it before, the best thing the government has done ever in financial services in my lifetime is eliminate commissions from financial advice. And now what you have is you have a lot of advisors these days that their core competency is investment management, which should have always been, but used to be salesmanship because they were selling stuff for a commission. So the quality of advisors these days, I think, is much, much better than what it was certainly 10 years ago, like substantially better, which is great for people. But, you've got to be prepared to pay a fair fee. And I don't think, just at first glance, I don't think Kayt's mum's paying a fair fee in that situation. I don't think I would tell Kayt to pay that fee to look after her monies, but there's some of the things that I'd be thinking about in her situation. Okay, the next question is from Andrew, and I'm just going to paraphrase. Andrew, I must have answered a question on a previous episode from Andrew, and he's asked a couple of questions about, what happens if they pare back CGT discounts, quarantine or cancel negative gearing, and then I made some comments about how much capital gains tax you can save versus having nil income versus being the highest marginal tax rate. So CGT discount, he's asked, if they remove the 50% discount, will they still have indexation? Look, what it used to be, and I can't remember when it changed, it was a Howard government change. It would have been about 15 years ago, maybe longer. You used to have to index the cost base, and the ATO would give you the indexation amount. So really what you're doing is just accounting for inflation. Rather, you're not going to pay tax on inflation, of course. So to work out what is the cost base's value today in today's dollars. So that's what it used to be. And then the more generous 50% discount was introduced. So I can't see them I think it'd be unconscionable not to have some sort of indexation. And so if they did reduce the 50% discount, they'd go back to indexation. Or maybe what you could do is if they reduced it, say 30% discount, for instance, maybe they would give you either or. You could either index your cost base or you could reduce it by 30%, something like that. But I don't think they're going to get rid of it in totality. And I think the government, at least at this stage, has said they're not going to make any changes. And the next question was, if negative gearing was abolished, would it increase rental yields? Well, absolutely. I mean, I would ask you that if you had to pay such a large amount to fund holding costs of an investment property so that you didn't get the tax deduction, what would you do? Well, you'd either sell the property because you couldn't afford it anymore because you don't get that tax deduction, or you'd pass it on through higher rental. I think both are going to happen, but I think because a lot of people that own investment properties aren't high income earners, so they're not getting a huge amount of negative gearing to begin with anyway. Maybe it's 30% or certainly not 47% for the vast majority of investment property owners, that is. So they're going to be sensitive to changes in tax legislation. They'll just sell the property, and what's going to happen? Shorter supply of rental properties, of course, yields will skyrocket. So yes, I think that'd be the outcome 100%. And I think any change in negative gearing would be short-lived for that reason. Would it actually be better for people not in higher income tax brackets? Yeah, definitely. Well, so what Andrew's saying there, if negative gearing was abolished, then it wouldn't be a strategy so attractive for higher income earners. Maybe it's better for lower income earners, but the problem is they've got a low income and they need those tax benefits. So I don't think so. And then finally, he's got a query about, and he sent his own calculations about, so I made a comment that if you make a capital gain, because sometimes people are like, oh, I'll sell this property when I retire and I've got no taxable income and I'm going to save a lot of money. But the reality is that if you've got 190,000 of income, you're going to pay about $55,500 on that 190,000. So the first 190,000, you pay 55,500, and then obviously anything above 190, you pay 47%. So what we need to do in terms of to ascertain what is the most amount of capital gains tax you will save by selling when you're retired versus when you're working, what we have to compare is how much tax do we pay on the first 190, and then how much tax would we pay if that 190 was taxed at 47%, because that's what, if you do crystallize again, that's what you're going to pay. And so it's really 55,500 versus 90,000. And so the most you'll ever save by delaying capital gains tax is about just shy of $34,000. So, $34,000 isn't a small amount of money, but it's not huge. I mean, if you're going to crystallize a huge capital gain, it's not a huge saving. And then maybe therefore there's a bunch of other matters you might want to consider. And what Andrew did is he did his own comparison and he thought it was worth more than that. But the error, Andrew, you made in your comparison is you included the tax related to the income that you might have already had. So for example, if someone is already working and they're earning 190,000, they're going to pay that tax already. And what Andrew did is he double counted the tax. But yeah, so anyway, it's interesting to keep in the back of your mind, because some people have an asset and they think it's overvalued and they like to exit, or it's a problem asset and they want to sell it. And sometimes they're really reluctant to do that, and they might want to hang on to it for a little bit of time because they think they're going to save a lot of tax. But when you actually work out, what the tax impact could be, particularly if you do still have taxable income in retirement, maybe it's not going to be as much. But anyway, thanks for the questions, Andrew. I don't think we need to really worry about taxation changes at this stage, as they might affect investors. I don't think they're going to be, politically attractive to make at this stage. Okay, next question is from Penny. Penny writes, I'm 66 years old and retired. So can I transfer properties in specie from my self-managed super fund into my family trust? I have 5 investment grade properties inside my self-managed super fund worth $7.5 million with $1.6 million of debt, plus a share portfolio on a wrap platform with Hub24 of $1.7 million. Well done, Penny. I should say you're obviously in a great position there. I'm considering moving either 2 to 3 properties out of my self-managed super fund into the family trust. My question, as I'm sure you will guess, is the benefit of avoiding both the additional tax on unrealised gains, not yet legislated, but likely, plus the additional tax on the super balance over $3 million. I appreciate you may need to pay stamp duty plus some capital gains tax when I sell from my self-managed super fund. Okay, Penny, great question. Of course, really timely question, given a few weeks ago the government actually changed these rules and made some much needed changes to make the legislation, I think, pretty good, pretty fair. And so now it is the unrealised gains are not taxed, it's only realised gains and income. And that balances over 3 million will pay 30%, or the proportion of your balance over 3 million will be taxed at 30%, and the proportion over 10 million will be taxed at 40%. And so Penny has about 6 million property and 1.7 in share market, so 7.7 million. So she's getting pretty close to the 10 million cap as well. And so there's some great questions there, Penny. I know, speaking to Campbell today, he's going to record an episode on these new super rules and what to do about them. We just did a calculation for a client Campbell and I are working on, and we've concluded it's not worth taking the property out. So to get the property out of a self-managed super fund, it pays a benefit payment rather than selling. And you can, depending on the state, most states you can argue there's no change of beneficial ownership, so you shouldn't have to pay stamp duty. So that will come out. You're going to need to think about what to do with the debt inside super, and which properties are secured. So you probably can't, I'd have to think it through, but you probably can't transfer out as a benefit payment anything with debt against it. You might have to sell them inside the super before moving that money out. But, the things you need to think about are the capital gains. Obviously, any capital gains acquired after 1 July or accumulated after 1 July 26 will start attracting a higher balance. So you've got to think about that, whether they'll be retrospective over those capital gains as well. And I'm not certain whether they're going to give you the discount. So normally capital gains are taxed at 10% as opposed to 15%. So you get a 1/3 discount. I need to look into that. But, the other things you need to think about what about tax on income? So if you put it in a family trust, who are you going to distribute the rental income to and what tax rate will you pay? And the other really big one is land tax. And particularly if you put it into a family trust, most states charge higher rates of land tax, whereas a self-managed super fund typically is taxed as its own landholder. So whether you own property personally shouldn't impact, or typically does not impact, the amount of land tax you pay. It's really just sort of separate taxpayer, if you like. Whereas if you bring it into a family trust, it could have an impact on, how much land tax you pay. In fact, we did the calculation for our client, and I think he'd pay an extra $17,000 a year in land tax, let alone the income tax benefits and so forth. So what I would say, Penny, is there's a few moving parts here. The proposed legislation, because it's not law yet, of course, has changed quite a bit, but keep listening to the podcast because we're onto it, and Campbell's going to record an episode about it. And I think that the cautionary tale here for this situation is that don't jump at shadows. It was funny, there was different times over the last sort of 18 months or 2 years perhaps, different times when, it would look like it was certain that it would become legislation. And then other times, particularly leading up to the election, it looked like it wasn't going to get through. And our view had been, been having conversations with clients about it, but let's not make any changes until it's absolute law. Whereas I've been hearing people drawing money out of super, doing stuff, making changes in advance of it becoming law. And that's the caution here, I think, is don't jump at shadows. Don't make any decisions until, you know the exact rules. And I'm proud to look back and go, well, thank God we didn't make any changes because the rules have moved and they're still only proposed, so they're not even law yet. So let's wait for it to become law, which will probably or should probably happen. Well, I don't know when Parliament sits and how much it sits before the end of this year, but it should happen over the coming months, and we'll be dissecting it, and particularly for property investors, right? Because they're the ones that if they've got a sizable amount inside super and they generate a lot of compounding capital growth, they're the ones that are going to be probably caught by this higher rates of tax. And I guess the other thing too, I mean, I don't know Penny's background, but it does show, you can accumulate substantial gains by borrowing to invest in property, and obviously Penny's in a great situation. So thanks for your question, Penny. Keep listening and we're going to dissect this issue as we do all issues, of course. Okay, probably out of time. Thanks very much for listening today. And tomorrow I think I've got I'd like to think it's an interesting topic to talk about. I'm going to go through an evidence-based approach to constructing a portfolio, and I received a question from YouTube or on YouTube. And it was about, for the finance nerds out there, some research Ilman and Ines have put together around evidence-based sort of multi-asset asset allocations. That they were both students of French pharma. So it's a bit heavy for, most listeners listening to this. Anyway, I'm going to break it down very simply about portfolio construction using an evidence-based approach. There's a lot of research around these things, a lot of deep research around these things. It's important to understand, we're just not throwing darts at a dartboard. Anyway, that's tomorrow, how to put a portfolio together, not only in shares, but property, cash, and the components, and how to construct that in terms of your overall investment assets. Anyway, that's tomorrow. Look forward to sharing that with you. Until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.